So I used to work with Peter many years ago in the foreign currency exchange industry, where he would educate the traders and our corporate clients on what was going on in the current world events, how that would affect foreign currency exchange risk. And he would educate them so that they knew what they were doing and didn't waste their money. So Peter has a lot of experience. He's got over 25 years of experience in global financial markets, including 10 years as head foreign exchange trader at ATB Financial, as well as 8 years at the Bank of Canada, where he was a senior fixed income trader managing Canada's foreign reserve assets. And he has a lot of expertise in treasury, risk management, cash flows, so on and so forth. So thanks for joining me here today, Peter. And I'm delighted to introduce you to our community so that we can get to know a little bit more. So I know that when we work together, a lot of our corporate clients, I felt that they would often put a lot of trust in what the traders and the salespeople were telling them, not really knowing the fundamentals. And I always felt a little bit bad that they were probably paying more than they should do. And so maybe you can share a little bit with us today about what business owners really need to do, starting with what is the foreign exchange rate and why is it important to understand that if you're selling overseas, as an example?
Okay, thanks, Pascal. Yeah, happy to be here and happy to shed some light on the foreign exchange market. Yeah, we'll just start this on a basic level. And, key thing is, okay, what is foreign exchange? Like we hear about it all the time. Well, in a nutshell, it's basically just exchanging one fiat currency for another. And because we presumably live in Canada, if anyone's, there may be people watching this outside of Canada, but we'll assume the average viewer here is in Canada. So you exchange your Canadian dollars for a foreign currency. And the conversion rate that you get for your Canadian dollars is what's called the foreign exchange rate. So, for example, the most common exchange in Canada for foreign exchange is against the US dollar. So when you say, okay, I need to buy 100 US, how much is that going to cost me in Canadian? And currently it would cost you probably around 127 Canadian for 100 US. So that is an exchange of Canadian for US, and the difference between the US rate, the US dollar and the Canadian dollar, or the amount extra Canadian you're paying, is the exchange rate. So, the convention can vary. I mean, typically the stronger currency is on the denominator and the weaker currency is on the numerator. So you said if it's a US CAD trade, then the US dollar is on the bottom. So $1 US, and then the higher number is going to be on top, which is the Canadian number. So you've seen the market that says 127. It's basically like 127 divided by 100 equals 1.27. So that's the exchange rate.
Okay, and what are the primary factors that influence the foreign currency rate?
Yeah, and that's the interesting thing about foreign exchange, and probably what makes it more challenging for many people as opposed to stock market prices or even bond prices. There's many things that can influence the foreign exchange rate. The most important probably is the interest rate differential between the two countries being considered. For example, again, we'll keep it simple and say, well, I want to buy US dollars, I have Canadian dollars. The main thing that's going to influence that is what are the expectations for interest rates in the two countries. And to determine that, you have to then look at a huge number of other factors. So what determines interest rates? It's basically expectations for economic growth and inflation in both countries. And who decides that? Well, it's the central bank. So how does each central bank view those two factors? And we can get into big detail, and I probably will be doing this in my course notes, but there's a whole bunch of economic factors that will be feeding into what a central bank considers when they change interest rates. And that's the basic answer, but then there's all the extra factors on top of it, such as political risk. How safe is the country? Generally speaking, in most industrialized countries are pretty safe politically, but if you were to need to buy, say, emerging market currency, it could be quite volatile. There's the political risk involved, and then there's of course regulatory risk and legal risk. Things can change dramatically. For example, in 2000, I believe the Swiss National Bank had their rate pegged to the euro, and then one day central bank decided not to honor it anymore. So there is a huge scope for risk in terms of foreign exchange. So the market will try and basically price foreign exchange based on what they think is important, but those factors can change. For another example, Canadian dollars typically called a petrocurrency and linked to the price of crude oil, but there can be times when that correlation completely dissolves and Canadian dollar trades completely oblivious to what crude is doing. So how do you know when it holds and when it doesn't? You don't. You just have to watch it and see if it's working at the current time. So anyway, I'll just say it's a very complicated market. Whereas the stock market, you have like earnings and you have interest rates, and those are primarily the two things you look at, and then you look at the competitive structure of the sector that's in. But in the currency world, you've got so many different factors that can matter or not matter at a given time. So it makes it a little more tricky.
And hence why it's important to plan for it, consult with someone like you to sort of mitigate that risk. So when you're making that exchange, it's not eating into your profits as a company.
That's correct, and that's what a lot of people don't appreciate is like there are, and we can get into this in this conversation, but there are many ways to hedge that risk. You don't have to accept foreign exchange risk when you have a need to do something abroad, or there are ways of limiting that risk. It's not always perfect. It can be slightly expensive, but that's what we're here to talk about, is how to judge which is the proper way of hedging that risk.
Exactly. And so one question I know that often comes up is, why is the rate shown on the news often different from what I see at a bank or a broker?
Yeah, so there's two things involved here. First, the basic one is when you have two currencies, there's two ways of quoting it. So for example, on the TV, the reporters will say, oh, the Canadian dollar is trading at 80 cents today. Well, you look at any kind of online rate, typically you'll see it the other way, 1.25. So why am I seeing it the other way? It's just a convention. So again, you can quote it either way, and both are correct. It's just the inverse of the other. So that causes a lot of people confusion, though, because the media typically talks about the 80 cents, whereas the financial markets, and you call a broker or whatever and they ask for pricing, they'll quote you 125. So that's the first thing. Then the second issue, and probably the more important one, is there is a lag in terms of pricing. So foreign exchange is basically priced in what's called the interbank market, and this is a market that's active 24 hours, 7 days a week. Technically you could be off on the weekend, but it is possible that there are trades going on anytime. And basically this is a real-time market between banks. And what people don't understand is like, okay, everyone gets their information from various brokers who get it from some monitoring of the interbank market, but there's going to be a delay. And if you want real-time data, you might have to pay for it. So depending on what you're paying your broker, if you're using an online broker, you may get information that's 10 seconds old, or you may get information that's 15 minutes old. And the market can move dramatically, or it may not. But typically speaking, when the market's moving quickly, the rate can vary dramatically from what you're seeing. So that's another issue. And then of course, the third issue is there's always going to be a price. So what you're seeing is, again, the interbank market. It's a very tight rate between banks. Basically there's only very little spread. However, if you're buying currency, especially if you're not buying a very large amount, such as like the interbank market assumes you're buying millions of dollars at a time. So if you're only buying, say, $10,000, you're going to be charged a spread, and that spread is going to be different depending on who you're using and what time of the day you're doing it. But it will vary dramatically, and that can explain why the price you're seeing from a quoted price from a broker or bank is much different from what you're seeing on your online app or your on the news. So it's something to definitely be aware of, because it causes a lot of consternation. Like, oh, that looks like a good rate, I'll go get that. And then you call up and you get a rate that's totally different from what you're expecting. And that can be confusing and irritating. So it's good to know why that happens.
So who's better to use to transact foreign exchange? Would it be a bank, a broker, a payments firm?
Yeah, and this always comes down to a variety of factors. For example, if you're just you're traveling and I'm going to be abroad, I'll need a little walking around money. Okay, well then you may not worry too much about using the airline, the FX conversion counter at an airport. I mean, you're going to get charged a dramatically high spread, but you're only going to have a limited need for currency. So it's not like you're worried that this is a long-term issue. It's just a one-off transaction. So that in case you may not be unhappy about just using whatever's convenient. And you typically that's a vendor at an airport, or you're just using Interac. It's like, oh, this machine allows me to take out pesos, but I've got a Canadian bank account. And so, yeah, you'll be able to get the pesos, but the bank you're using is going to be charging you a significant spread to do that. So those are times when you don't really care too much. It's like, okay, it's just an expense that I'm not going to spend too much effort to worry about. However, if you're a regular transactor of foreign exchange, or you're doing a large amount, then it becomes a lot more significant as to what your choices are. And typically in the past, what we've seen, and again, this is most germane for, everyone, but of course, like the sort of sector that we've focused on in our careers have been sort of small to medium type enterprises where they have, fairly consistent need for foreign exchange, but not huge amounts, but enough that over time the cost matters. And therefore in the past, like, oh, I've always used such and such bank. They've always been good to me. I'll use them, not knowing that the spread they're charging is quite significant, and you could save money if you shopped around. So the key thing as well, if I'm using a bank, but maybe I should talk to some other banks just to make sure I'm getting treated fairly. And that's one thing. And then of course it's like, well, I had this guy call me up and he's working for a non-bank payments firm such as, Western Union, and they're showing me this rate. And how come that's so much better than the bank's rate? Well, it's because they focus on trying to get this type of client and this type of business. And so they're going to be much more aggressive in chasing you. And that's what we've seen over the last 20 years is there's been a lot of focus on, the bank's charging me too much. I should be able to get a better rate. And there are a lot of competitors, and there's been some consolidation in the industry, but nonetheless, it's still an area where there is scope to make savings if you do shop around. And so, and again, a lot of these payment firms are automating their systems so that you have a inventory. You need to buy inventory. Okay, this is a preset vendor I'm using. I can just, I'll program it in, and they click a button there. I bought my US for the month, and I got my order to purchase my inventory. So, that's an attractive way of doing it, as opposed to, oh, I'm going to go to the bank and then I have to transfer the money to this guy so they can pay the vendor. So there's cost efficiencies involved in what you're doing with that foreign currency you're buying. And so it may be the case that your bank is showing you a better rate, but the other vendor is the whole back end process is easier using, the non-bank, and you may be paying a little more, but maybe it's more efficient. So there's all these factors to consider, but that's the thing. I guess the last thing is a lot of counterparties, the credit worthiness, especially in times like this where the market's very uncertain, you want to be careful about who you're dealing with. For example, if you're buying a derivative contract where there's not immediate settlement, say an option, and like all of a sudden your counterparty goes bankrupt, well, you've got a hedge that's no longer applicable because you don't have any guarantee that contract will be honored. And we've seen this a few years ago when Encore FX basically, had to wind up business because they couldn't honor all their derivative contracts because they had counterparties that couldn't honor theirs. So, it's the credit worthiness of the institution, how big it is, that does matter. And especially if you have complicated, again, contracts that do not settle immediately, you want to make sure that who you're dealing with is going to be around. So it's something to always keep in mind.
And also, if you need exotic currency, you may not have a choice because the bank won't have it.
That's a great point, and I forget that it's true. Some banks only carry vanilla currencies such as like US dollar, or euro, and I need to buy Indonesia rupee, or I need to buy Thai baht. Well, it's like we don't have it. Yeah.
Exactly.
So you have to be able to find what you're needing, and then sometimes you'll have to pay more for that too.
Okay. And so what kind of tools are available to transact foreign currency? You mentioned the online portals. I guess that covers it. Is there anything else that a business?
That's it. I mean, you've got, it's a transition industry where you still have the old, well, I'm going to walk into the bank I'm going to ask for 10,000 US out of cash out of my account. So that's one way of doing it. Or, of course, you can do it online now. It's like I have a US dollar bank account with my bank. I'm going to transfer 10,000 US from my Canadian account to my US account. And yeah, then there's all kinds of, oh, I want to buy US stocks, but I have a broker that allows me to, transmit, Canadian funds out of my Canadian account and then into a US account and then go buy stock, or just buy the US stock directly and get charged a Canadian rate for it. So there's different ways of doing it. And of course, this question is also germane to, when I'm buying currency, what am I needing it for? And do I need to buy spot currency and have an immediate transaction, or do I want to do a forward? Do I want to, I don't need the money right away. I can't afford to buy it right away. I'm getting some cash in a month, and then I'll be able to buy the currency. But I think this is a really good rate right now. I don't want to wait till I get the Canadian cash. I want to execute now. And as long as you have the credit with your counterparty, where it's your bank or whoever you're using as a vendor, if they're going to give you the credit so that you can put on a forward contract, maybe that's the way to go. So that way, I've got this rate locked in. I'm pretty happy because I think this is a good rate. And I don't have to pay for it until my money comes in on the Canadian side. And that's a potential. And then you get more exotic and you can look at options. And it's like,
Can you sorry to interrupt you, can you just explain the difference between a spot transaction, a forward, and the hedging? Because I do know that a lot of times if you're dealing with a brokerage and you want to do a spot transaction, meaning an immediate transaction today, often the brokerage would try to push you towards forward or hedging, because that's actually where they make the money. They make more money there. Yeah. I just think our listeners need to be aware of that. So can you just explain the difference between those three?
Okay, as you know, this is a kind of a pet peeve for me anyway, so I don't mind.
Both of
us. Yeah, like I said, the past history of foreign exchange was that there was a lot of money to be made, providing foreign exchange even on a spot basis, and you could see a commercial bank charging 200 points. Like, for example, if the rate's 127 in the interbank market, they would charge you 129 to buy, say 50,000 US. It's like, so that's a profitable transaction. But as there's been more and more competition going into the spot market and providing those rates, the scope for charging 200 points is decreased. And now you might get charged as low as 10 points or 5 points, depends on which broker or bank you're using. So the profitability of the spot transaction has diminished dramatically. But then that's when they try and upsell you. It's like, okay, yeah, we can provide you spot business, but you know what? We think you're better served by trying to time the market, and we're going to provide some hedging advice for you. So this is where they try and basically, they said forward contracts may make sense if you don't have the cash, but you want to lock in a rate. But it's also a way for the banks to what's called transparency. And so you said you can look up the Canadian dollar spot rate any given time of the day. And there may be a time delay on your feed, but you're going to get a pretty close approximation to where the market is if you have something that's close to real time. So if you can just go on and Google like Yahoo Finance and look at the Canadian dollar rate. It's probably only 5 minutes delayed at most. So that rate is going to be pretty close to where the market is most of the time. However, if you're doing a forward rate, you don't know where the forward rates are because that's not easily found.
Forward meaning a time in the future. So
so just to clarify, forward rate is a time in the future. So for example, the spot rate we talk about is like, okay, there's a delay in settlement of a day or two, and particularly in Canadian dollar, it's 1 day settlement. So you buy the rate today, you get the money tomorrow. A forward rate is like, I buy the rate today, I don't actually transact until a future date that's specified. And typically, most forward contracts are under a year, so 1 year or less. And so, okay, I'm going to buy this US, going to lock in the rate today, but I'm not actually going to receive the US for 3 months. And that's called a 3-month forward contract. And that is great, except you don't know what the forward points are. There's always a forward adjustment. Now, it's not a huge issue in the forward market because typically it depends on the interest rate differential between the two currencies involved. And when we're talking about, say, US and Canada, both of them have had rates near zero for the last few years. And even if the rate increases we're seeing, they're both increasing at about the same pace. So the forward rates haven't changed that much because the interest differential between the two countries hasn't changed too much. So there's not a lot of scope for the banks to make money there, but that's when they will try and move you to an option structure. And that's where this rule can be an issue. It's like options are very useful. They provide leverage, they provide flexibility. However, they are expensive for that reason, and they're not transparent at all. And this is why almost every foreign exchange provider will, if you're doing regular business, they'll eventually have a conversation with you where they say, hey, you know what? We can give you this really great opportunity where you can lock in these rates, and there's a potential for even more upside. However, if there is you have to accept at some point your upside is capped, or there could be a downside if you've got prepared to prepare that risk depending on the structure they're selling you. Now the problem is that all these may make sense, and most of the time they're made with good intentions. However, again, it's not a transparent market. You don't know what the option premium is. You don't know what the real cost of an option is. That's only known between the interbanks and who their non-bank clients that they're providing option pricing to. So they don't divulge to standard commercial or retail client what the actual price of the option is. So you may think, okay, that sounds good, but you're maybe taken advantage of. You don't know, and that's the problem. So again, it's a question of, well, I can't just use one broker or bank. I need to shop around if I'm going to do something like this. And that's really what it comes down to. It's just caveat emptor, buyer beware, and do your research. And that's sort of what I'm sort of trying to be helpful here, is just like, yeah.
Exactly. Provide the information and the education, take the time, because it will pay off in the short and long term.
Yeah.
It also begs the question, how well do forward rates predict future exchange rates?
Yeah, and then I included this as a discussion point just because it's, it's like, okay, so you're telling me I can lock in a rate for a year from now. Okay, that sounds great, but is that rate actually going to predict correctly where the market is going to be? And the answer is not really. So again, the foreign exchange market at any given time takes in all the information it has, and you assume the market's efficient, and that's a point that's debatable at times. But based on the current information available, that is where the market thinks the Canadian dollar will be in a year's time. However, in practice, you get just as good as results throwing darts at a dartboard, and that's the sad truth is things can happen quickly. Assumptions are wrong. For example, we can just look at rate increase by the Federal Reserve. It's like, well, even the Bank of Canada, the last Bank of Canada increased the market expected 75 basis points, and the bank hiked 100. It's like, okay, that will throw out everything that had been built into predictions, including the Canadian dollar forward rate. So that's just where it says, like, you can just use it as a base case. Like, okay, when people say, okay, this is going to predict where the market's going, no, it's not. What it is just is allows you to lock in your risk, and that means you have to be comfortable with that choice. It's a lot of people lock in a forward rate and say, oh my gosh, why did I do that there? Well, at the time you thought that was a good rate.
Right.
And that's why a lot of people prefer options, because that does give them flexibility. Oh, I didn't totally lock myself in. Or what people do is they have a need to buy, say, 100,000 US, and they only buy 50,000. They say, I want to give myself full flexibility. So you can either do like half your exposure using forwards, or you can use options. So the interesting thing is that with forwards, again, as long as you have the counterparty credit, they're free. They're relatively free aside from the spread that you're paying the institution. But with options, there's a premium, and that may or may not be. That's a upfront cost, and you may not get that. Your option may expire worthless. So that's a cost. So options are costly. And one thing I didn't talk about is futures. So people go, well, banks talk about foreign exchange forwards, but then I hear in the market it's futures. What is the difference? So the futures, when you talk about a foreign exchange forward, that's an over-the-counter contract between you and the counterparty you're using, typically a bank. The futures market is an organized exchange, typically it's the Chicago Mercantile Exchange in Chicago, that basically offers foreign exchange futures contracts. So in this case, a typical futures contract is assumed to be $100,000, and you're buying one future that, it depends on what date you want, 3 months, 6 months. You buy that futures price and you've basically locked in that transaction at that date. And okay, so what's the difference? So you've basically done the same thing as you did with a forward. However, with a forward, you can't go call the bank and say, hey, I want to sell my forward contract. You're stuck with that contract. With a futures contract, you can sell it back anytime you want, or you can go short, you can go long those contracts. You can short, you can sell more, you can sell contracts that you don't have. You're shorting the currency that you're shorting the contract. So it's a contract that's available on a standardized exchange, whereas a forward is an over-the-counter product. Which is better? Again, it's really a question of what you're doing it for. There's definitely commission fees in buying futures contracts. You're going to be going through a broker. You're going to get charged a lot. Again, you'd have to shop around to see what kind of price you're going to get from various brokers that give you access to the exchange. Whereas a forward, you sort of, okay, it's between you and your institution that you're using, and you're done, and like you're stuck with that contract and you can't get out of it. So whereas a futures contract, you can get out of it if you want to sell it. Anyway, that's a
great, yeah, no, but that's a great overview. And I'm sure for some listeners that might sound complicated, but that's how you can help them. So before we finish up, I have a totally random question, nothing to do with the markets.
Okay.
And that is, if you could have dinner with anyone dead or alive, who would it be and why?
Oh, that is a really tough question. I have,
and I'm just throwing it out there. You didn't know.
I'm gonna, since it's a non-market question, I'm gonna give a non-market answer. I would like to have dinner with George R.R. Martin, and I would like to ask him, like, when are you gonna get the Game of Thrones novel series done? So.
Well, that you know what, that's a good question. So I wouldn't have expected you to say that, but that's great. Yeah. So thanks again, Peter. Really appreciate your time. And for those listening and watching, I encourage you to follow Peter and his excellent daily commentary. You can find him on LinkedIn and on Twitter. His Twitter handle is Peter, capital R, Hann, and the number 1. And if you have any other questions for me or Peter, you can email us at info@zadacorp.com. Thank you so much, and bye for now.
Bye.